and welcome to the kickoff of our RAS Connector series. My name is Jean Codin, and I am the Associate Editor of Hatchery International and RAS Tech Magazine. On behalf of our parent company, Annex Business Media, and our RAS Connector series team, I want to say welcome to all of you. We have a great program for you today, the first of our trio of virtual events this year. And what a great day to start us off, because today we are running two parallel programs. Today's RAS Investors Forum brings together the thought leaders in the RAS sector with the investor community to talk about the potential of the recirculating aquaculture system technology. While we're here, we also have a second event with our country partner, the Danish Export Association. The Danish RAS technology seminars are running right now in a second channel where they are showcasing the knowledge and developments of Denmark's aquaculture space. So with this one registration, you have access to all the sessions and events we have planned today and for the rest of the year. For those of you who don't know, the RAS Connector series brings together experts, suppliers, and industry influencers from around the aquaculture world to this one online interactive platform. These events are in collaboration between three aquaculture brands: Aquaculture North America, Hatchery International, and RAS Tech Magazine. We would also like to acknowledge our sponsors who have been great supporters of our virtual events. Thank you to our gold sponsors, Atlantium Technologies, AquaCare Environment, AquaMayoff Aquaculture Technologies, InnovaSea, Oxygen Solutions, and Skredding. Thank you also to our silver sponsors, Aquatic Equipment and Design, Integrated Aqua Systems, and Structural Armor. Special thanks also goes to our strategic partners, Control Aqua, NoFEMA, University of Sterling, and Virginia Tech. So if you attended last year's RAS Virtual Summit, you will notice that we are on a new platform. To view today's sessions, you can click on the session title and the sessions page of the corresponding time. During a session's broadcast, you have a chat box on the right of your screen where you can ask questions and interact with fellow attendees. We also have many opportunities for attendees on both the Investors Forum and the Danish RAS seminars to come together for breaks and check out our virtual trade show at the exhibit hall. Our exhibitors will be available to speak with you throughout the day through their own public chats or through a one-on-one private chat. The networking page is where you will find our full list of attendees, speakers, and exhibitors. If you'd like to chat with someone, you can click their name to initiate a conversation. We have a lot of content coming your way today, so I want to remind you that all of our live sessions will be recorded and available on this platform within 24 to 48 hours of the broadcast. In addition to today's live events, we also have a library of on-demand sessions for you to browse at any time. You can now find those below our live schedule on the sessions page. All right, without further ado, it is my pleasure to introduce you to our keynote speaker, Maggie Frade. Maggie is the head of the Oceans, Seafood, and Aquaculture Investor Consortium at CREO Syndicate. She works with family offices and aligned investors on deploying $250 million over 3 years across the capital stack into sustainable oceans and aquaculture solutions. Please welcome Maggie Frade.
Thank you, Jean. Hello, everyone. Let me just pull up my presentation and we will get started. Great. So let me start out by telling you a bit more about CREO and the work that I do, which will provide context to what I'll be sharing over the next half an hour. CREO's mission is to catalyze capital into solutions that address climate change and the sustainability challenge at scale. We believe that family offices have a unique opportunity to play a leadership role in the transition to a more sustainable and low carbon future. Later, I'll get into why family offices are in a unique position to invest in RAS, which is why so many companies approach them for early funding. For those of you who are not familiar with family offices, there isn't a standard definition. There's no hard and fast rules about this, but a family office is typically established when a family has 100 million or more in wealth. They are institutional-like vehicles that manage the affairs and assets of the family. Every family office is structured and staffed differently, but on the financial side, a family office will typically manage or oversee investments, tax and estate planning, and philanthropic activity. CREO has become the leading global resource for family offices seeking to invest with a climate and sustainability lens. We currently engage with over 100 family offices around the globe, as well as more than 1,500 aligned investors and hundreds of partners on developing and scaling solutions to the climate crisis across sectors, asset classes, and stages. As a nonprofit organization that seeks to connect informed investors with aligned investment opportunities, but is neither an investor nor funded through fees when collected when our members invest, we are a neutral market player. What does that mean? That means that if the investors I work with are seeking to invest in aquaculture, then I will connect them with investment opportunities and expertise. But there's no financial gain for me or for CREO if they invest or if the investment is successful. So what do I do? Well, CREO and our supporters saw that aquaculture was a growing area of interest among family offices. As you know, aquaculture, if sustainable, offers a compelling opportunity to meet the global demand for animal protein while creating economic and environmental value. However, there are a number of barriers that are inhibiting the growth of the sector and the shift towards more sustainable practices, one of which is a lack of capital. In parallel, we saw that investing in sustainable aquaculture can be challenging. Outside of Asia and a few other geographies, the aquaculture sector is young. Plus, seafood markets are complex, global, and opaque. This makes it challenging for investors, particularly those who are new to the sector, to find and evaluate investment opportunities and determine who to invest alongside. In response to both the potential of the sector and the challenges of investing in it, last year we created and launched the Oceans, Seafood, and Aquaculture Investor Consortium. OSAIC, as I will refer to it moving forward, is a group of investors committed to collaborating on and investing in the development of robust, sustainable oceans, aquaculture, and seafood sectors. OSAIC members are all actively investing in these sectors, and the goal is that this group will mobilize at least $250 million of capital into sustainable oceans, aquaculture, and seafood investments by 2023, with the broader goal of catalyzing investment by institutional investors in the longer term. By collaborating on overcoming key barriers to investment and driving more capital into the space, we will move the needle on developing a strong and sustainable blue economy. Through the development and growth of OSAIC over the last year, I have seen land-based aquaculture surface as an area that holds significant interest for investors. Yet, many are not investing. So today we'll explore what is driving this excitement and concern, as well as what might be done to diminish some of these concerns and increase the flow of capital into RAS investment opportunities. I'll start by focusing on investments into aquaculture more broadly and what factors are driving excitement about RAS. Then we'll turn to the reality of the funding situation for RAS projects. Finally, we'll turn to looking at two broad areas of risk for investing in RAS and the solutions that are emerging that might diminish those risks and alleviate investor concern. However, before I jump in, I would love to get a sense of who is in the virtual room today. So take a minute to write in the chat where you're located and whether you are an investor, company, practitioner, or perhaps don't fall into one of those categories. Great. I always enjoy seeing who is in the room, even when we aren't all in the room together. As I mentioned, CREO has seen that aquaculture is a growing area of interest for investors, particularly in the last few years. Looking at investments into private aquaculture companies since 2008, you can also see a significant increase over the last 5 years. While data sources such as PitchBook and Crunchbase, which is where the data from this graph came from, are not inclusive of all investments, they do provide a solid picture of capital flowing into the space. According to PitchBook data, up to 2019, $12 billion had been invested in aquaculture. And I want you to keep that number in mind, 12 billion up to 2019, when we talk later about capital needs moving forward. Now, there are several factors that are contributing to this growth, which I will touch on briefly. The first is that an increase in wealth in emerging markets has made protein more accessible financially to a growing population, which, along with growing population growth, is driving increased demand for protein. Ongoing overfishing has led to the stagnation or decline of a majority of wild fish stocks, which points to aquaculture as the means by which global seafood demand will be met. As this graph shows, the market value of aquaculture is expected to continue increasing over this decade while wild capture remains stagnant. And this projected increase in value is why aquaculture is of such interest to investors. Now, there are a number of barriers that need to be addressed for aquaculture to scale to meet this demand and to do so sustainably, ranging from regulation to social license. But in the interest of time, I will not address them. On the capital need side, the need is significant. If aquaculture is to meet the growing demand for seafood in both an ecologically and commercially viable manner, it will require immense capital across the value chain, potentially up to $300 billion by 2030. So if you imagine that 12 billion was invested to date up to 2019, and 300 billion is going to be required in just the next decade alone, we have a lot of work to do. The increasing investor attention paid to aquaculture means there is a chance that these capital needs might be met, but there's still so much work to be done to ensure that the capital flowing is informed and is driving growth that enhances rather than depletes natural capital. As I mentioned earlier, I have seen increasing investor interest in land-based aquaculture, particularly in RAS. Let's examine some of the factors that are driving this interest. There are a number of factors that are tipping the scales in favor of land-based aquaculture. First are the financial and environmental benefits of removing aquaculture from the ocean. This eliminates the costly and prevalent issue of sea lice. As land-based aquaculture becomes more cost competitive with net pen aquaculture, the cost of managing sea lice is financially disadvantageous for net pen aquaculture. Removing aquaculture from the ocean eliminates the risk of mass die-offs due to unforeseen ocean changes such as super chills and algal blooms. And unfortunately, as we know, changing ocean conditions due to climate change will only become more problematic over time. In addition, while RAS can have its own negative externalities, it does eliminate the environmental damage to the ocean due to nutrient loading, seabed damage, and escapes. The second is the increasingly competitive CapEx and cost of production. While capital expenditure and cost of production for RAS is currently significantly higher than that of net pen aquaculture, the comparison starts to look a lot different when you factor in the rising cost of licenses and air freight. As this graph illustrates, the CapEx of traditional cage-based farming can be higher than the first phase of RAS when licenses are figured in. RAS further looks like a strong alternative when you add to this the limited number of sites available for nearshore aquaculture and the expectation that once RAS facilities are standardized and scaled, the capital cost should decrease significantly. Third are the benefits of locating land-based aquaculture facilities near end markets, providing year-round access to seafood, even species that are not native to the area. Local production also provides high quality seafood to areas that previously did not have access to it. And for investors, this means accessing new markets, and when RAS has scaled, the potential for large scale, year round sales programs with consistent pricing. Local production can also significantly diminish expenses after the farm gate. Distribution costs can greatly increase the end cost per kilo of seafood products because while trucking costs about 10 to 20 cents per kilo, air freight adds $2 per kilo. The increasing cost of air freight will continue to tilt the economics in favor of RAS. Building on this, air freight increases the carbon footprint of the end product. As this graph from Liu et al. Demonstrates, at the farm gate, the carbon footprint of open net pen production is lower, but when you factor in transportation, fish raised in net pens and transported by air have a significantly higher carbon footprint than that of RAS on predominantly hydropower or US electricity. As increasing numbers of investors and consumers value sustainability metrics, the differing carbon footprints could give RAS produced seafood an environmental and financial edge. The COVID crisis has also sharply highlighted the value of locally produced food in times of global crisis. The closure of borders and the reduction of global shipping routes severely impacted the ability of the seafood industry to get products to end markets, resulting in decreased sales and increased costs as fish were left in the water longer. RAS production can provide local or regional food security, even in geographies with no ocean access. The facilities can be located close to major end markets, which reduces concerns about the fragility of complex distribution systems. And the end product is easily traceable with a clear origins and sustainability story for the end consumer. Lastly, recent proof of concepts like Atlantic Sapphire's first commercial harvest last year are increasing investor interest in a production method with a long history of failures. So what I want you to take away from this is that there are a growing number of reasons why investors are interested in RAS. The question then becomes, if all of these factors are driving interest, are investors actually investing? To answer this, let's first take a look at projected versus actual production volumes in recent years. In a 2017 seafood report, DNB projected that by 2020, over 20 land-based projects were expected to be producing 150 metric tons. In 2016, approximately 10 projects had produced about 7 metric tons. So the expected increase over 4 years was significant. The expectation was that we would go from 7 metric tons to 150 metric tons. Yet, as we know, that did not happen. In 2019, DNB reported that production was nowhere near the projected figure, but they also noted that they had identified over 500 metric tons of planned capacity by 2026. Why have planned production volume estimates published by DNB and others not come to fruition? Before I share my thoughts, I will ask you to share yours. So once again, in chat, I'd like you to write in one word, and I know it can be hard to just put it in one word, but why you think these targets are not being met. While there are a number of reasons, the most common is that companies fail to secure the necessary capital, whether it is new companies seeking to build their first small-scale facility or an existing company looking to scale production after completing their pilot grow-out. So when you compare identified production volumes with planned production by companies that have already achieved traction with investors, the numbers vary wildly. CREO Securities has identified more than 2 million planned tons of land-based salmon production and recognized that that list of projects is so long that at this point, that number is likely too low. However, when they looked at planned production by companies that have raised at least $50 million, as you see here in this graph they produced, volumes are reduced to approximately 120 metric tons by 2025. I just want to take a minute and really let that difference sink in. From 2 million planned metric tons, although the time frame on that might be longer than 5 years, but still from 2 million metric tons down to 120. Given the struggle of companies to raise capital, 120 seems like a more realistic number. Most RAS companies start by raising capital from friends and family and then turn to family offices before institutional investors. Following that, we are now seeing established land-based companies go public to secure the large amounts of capital needed while also working to secure debt financing. Later today, I'll be talking to Ohad Maiman from the Kingfish Company about how they have fundraised over time, and I hope you'll join us. For now, let's focus in on family offices as they are often approached to finance RAS companies when companies are getting off the ground or need growth capital. Why is that? Because family offices are often willing to invest with the longer time frame needed for farming, and some have pockets deep enough to fund the high CapEx and working capital needs for RAS. If you look at the investor base of most major RAS companies, you'll find at least a few family offices. This means that family offices can play a critical role in funding the growth of this industry. Now, I previously shared why investors were excited about RAS. Now I'll turn to concerns that I'm hearing that are preventing those same investors from investing. It is important to note that I only work with a small portion of family offices globally, but I have heard similar feedback from investors outside of OSAIC, whether family offices or institutional investors. And what I hear is that the economics are not yet right. The projected returns are not high enough for the significant risk that still exists. I hear that the cost of production is still too high and needs to be closer to that of ocean-based aquaculture. And I am hearing concern that companies will go through too much capital and take too long before they can figure out technical issues at scale. Many of these concerns are reflected in this graphic from Rabobank, which outlines the key areas of risk for RAS operations: financial, operational, social and regulatory licenses, and marketing risks. The concerns I've heard from investors strongly fall into the financial and operational, so I will focus on those, although that does not imply that the other two are insignificant. One metric that's valued by investors that ties together financial and operational risk is the cost of production. So let's turn to that, as investors often want to see a cost of production that can be achieved that is on par with ocean-based aquaculture. Or if the cost of production is higher, they want to see that consumers are willing to pay a premium. The 2016 study by Liu et al. On the comparative economic performance of RAS and open net pens concluded that total production costs for the two systems were similar, with head-on gutted prices of Atlantic salmon of $5.60 a kilogram for RAS and $5.08 a kilogram for open net pens. However, the authors concluded that factoring in capital costs meant that fish raised in RAS facilities needed to be sold at a 30% premium to be comparatively profitable as those raised in open net pens. This assumption means that the quality of RAS raised fish must be on par or superior to net pen, and this is important, consumers are willing to pay more for that product. Now, the study was based on data from the Freshwater Institute's concept level grow-out system, but with Atlantic Sapphire and others moving beyond concept or pilot phases to commercial scale, we can build on this data. Investors I spoke to expect that in the near term, Atlantic Sapphire will reach a head-on gutted cost of production of about $9.45 to $12 a kilogram. Now, I do want to take a minute to note that I'm using Atlantic Sapphire here to neither promote or pick on them, but because many companies I speak to discuss the hypotheticals of their cost and pricing models at scale before actually reaching scale. So using Atlantic Sapphire as an example provides us with more concrete data. In a 2019 report on RAS, Rabobank argued that for RAS salmon to be successful, production costs will need to be between $4.22 and $5.21 a kilogram by 2030. Now, I understand this is not the most rousing picture for me to paint in the keynote, but it is one rooted in fact. But here is another data point that paints a rosier picture. I spoke with investors who believe that Atlantic Sapphire, with smooth operations, will get to operating costs of $5 a kilogram by 2025 and be competitive with ocean-based farming. The question will remain, though, of whether others can replicate that success and with how much time and money. However, if you return to my earlier comments on the negative impact of air freight, sea lice, and licenses on the economics of ocean-based farming, RAS becomes cost competitive. Now, I'm sure when I share the concerns about RAS that I've heard from investors, there are some of you who disagreed strongly, feeling that those investors must not understand the full picture or think that your project has the answers and can overcome the financial and operational concerns. While other species, other technology designers, other companies might lead to different figures, the bottom line is that investors see that RAS might have tremendous potential at some point. And what I want you to take away from what I've shared in this section is that current high costs and capital needs leave questions of whether now is the right time to invest. For RAS to be an economically viable and widely used approach to aquaculture, we can't keep failing and failing wildly to hit projected production volumes. Yes, in any new and disruptive industry, there are a large number of companies that ultimately don't make it. However, in order for this industry to grow, we must think about how a greater number of investors can become more comfortable investing, whether funding early stage companies or financing the growth of established ones. One way to do that is to figure out how to move from that small pink dot in the dead end quadrant that you see here in this graphic to the large 2030 circle. Now, I don't pretend to have all the answers, nor will I pretend that I have the remaining time to go through even a portion of the thoughts that I do have. So we will address one that I believe is key. How can operational and financial risk be diminished? And what role can RAS companies and investors play in this? To answer this, we must zoom out beyond our current focus on RAS producers themselves and look at the broader ecosystem of technologies and services that support production. If you look at this broader ecosystem, there are three areas of innovation that can improve operational efficiency and diminish risk: feed, genetics, and a third area I'll call ancillary technology that includes sensors, cameras, and AI. These three categories are not distinct as they often overlap and bleed into one another. Now, given that feed can represent up to 70% of production costs and impacts fish health and quality, it's an area of profound financial and operational risk. We are now seeing RAS-specific feed formulations have the potential to reduce or eliminate, which would eliminate the need for purging, which increases financial efficiencies and potentially improves quality and therefore profitability. There's also startups working on biotechnology advances to encapsulate the essential nutrients and oils in feed. This would improve the digestibility and efficacy of feed, which can improve fish health and decrease the amount of feed used, which would also bring down costs and working capital needs. Another area that can drive down feed costs is genetics, which includes GMO and standard broodstock management. Although not without controversy in some aspects of it, advances in genetics are able to reduce the grow-out period, and as you'll recall, the long production cycles combined with high capital needs is a concern for some investors. These same advances can improve feed efficiency, which would reduce working capital needs. According to AquaBounty, their faster growth to harvest rate results in a 1.7x increase in harvest, along with a reduction of feed costs by 25%. It should be noted that while some genetics innovations may decrease operational and financial risk, companies focused on some aspects of genetic modification are likely to face increased regulatory, social license, and consumer acceptance risk. Ancillary technologies includes innovations like cameras that can provide accurate biomass counts or detect fish health issues, sensors that can monitor water quality to prevent mass die-offs, and AI that builds on data from cameras and sensors that can optimize feeding and farm operations. These technologies decrease operational risks like animal health issues and mass mortalities, and financial risk from the negative impact on profitability from overfeeding or inaccurate biomass counts. So bringing this back to the earlier discussion of cost of, one investor in the RAS value chain I spoke to estimates that overfeeding contributes $2 a kilogram to production costs, while accurate biomass estimation can reduce per kilogram costs by about $3.40. So RAS current cost of production is around $10 a kilogram and is trying to get closer to $5. These kinds of reductions can play a key role in achieving cost parity with ocean-based production. And what I want you to take away from this is that, yes, we have a lot of work to do towards decreasing the cost of production, but we are trending in the right direction, and the tools exist to help us get closer to the needed numbers. The issue is that these kind of investments often present a chicken and the egg question for founders and for investors. Should investments be made into the technologies and inputs in the RAS value chain before a solid number of producers have shown that they can operate at scale? While I am not here to offer investment or business advice, in my position between investors and companies, I can say that logic is flawed. It is clear that these innovations can decrease operational and financial risk for production, which will in turn enable RAS production to scale more efficiently. RAS producers can partner with these startups in their product development, which gives the producers early mover benefits of using a new technology, while the new technology or service providers can demonstrate real-world feasibility and customer traction in order to attract investor capital. It is a symbiotic, not a chicken and the egg relationship. Investors who see the potential in RAS can invest in these technologies and services that will enable the industry to grow, reap the upside of this growth when production grows, and create enabling conditions for other investors to fund RAS projects. Before I conclude with key takeaways, I'd like to ask a final question of you. In the chat, write one innovation that you think could drive the overall success of the RAS industry. And I'm hoping, I know there's a bit of a delay, but I'm hoping that you'll still be able to put one thought, I know it's hard, in the chat. Great. I was asked to provide a reality check today and I hope I've done so. From an investor perspective, I have highlighted not just the areas of opportunity, but also the challenges that need to be addressed for this industry to scale successfully. Before I conclude and take questions from you, I would like to offer 5 key takeaways. RAS is an industry that a growing number of investors are exploring. And those investors range from early stage investors willing to take significant risk to those investing in later stage opportunities. The stagnation or decline of wild stocks, combined with the limitations of ocean-based farming, boost the potential of land-based aquaculture. Combine that with what we've seen over the last year, that local production offers food security benefits in addition to the financial and environmental ones, and that commercial scale harvests are not only feasible, but consumers will buy the products. However, the inability to raise capital continues to be a main barrier to actualizing planned production volumes. Investors who are interested in RAS express concern about the economics and ongoing operational challenges. It is clear that for RAS to become a widespread production method, significant capital will be needed, and to acquire that capital, companies must address investor concerns around financial and operational risks. An examination of the current cost of production shows the reality of these concerns, as current costs are more than double that of ocean-based production. However, we are on a path to cost parity, and the pieces exist to help us reach that goal. While the technologies exist to improve operational efficiency and diminish some of these risks, they are often early stage, not targeting RAS companies as a market, or underfunded. If these technologies can help those who are at or approaching commercial scale bring down costs, then we will likely see more investors willing to invest in those projects. This will lead to additional proof points and diminishing costs, which should in turn reduce the challenges for early stage RAS companies to fundraise. And this will further accelerate the growth of the whole industry. The focus so often is on production itself, with a view that production at commercial scale should be achieved before investment into the ancillary companies that are part of the RAS ecosystem. Yet, widespread production at commercial scale likely is not feasible without these technologies and services. For RAS to become a widespread reality, we must catalyze innovations in inputs and ancillary technologies and services that can push the industry forward and drive its success. Thank you.
Thank you, Maggie, for your presentation. All right, let's get into, just as a reminder for the attendees here, the presentation, as well as all the live presentations today, will be recorded, and it will be available on this platform within 24 to 48 hours. All right, Maggie, I'll start with a question. Are you able to say what notable RAS projects you're currently involved in or you're currently looking at?
Unfortunately, I can't. Like I mentioned before, I work with and in some cases represent a group of family offices, and the projects that they invest in are confidential.
There was an audience question sort of related to that. Richard Hunter from Georgia RAS Development asks, what percentage of the 250 million that you mentioned is earmarked for US projects?
Yeah, that's a great question. Thanks, Richard. So there's not necessarily an amount that's earmarked. The investors that I work with invest according to their own investment strategies, but our focus is primarily on the Americas and Europe, because we feel like the aquaculture sector is so advanced in Asia that we wanted to focus on these other geographies and help them scale.
What are some key questions investors should be asking before they invest? Or because we have a lot of RAS producers in our audience today, what questions do they need to answer to capture the eye of investors?
Yeah, so I can share a bit about what I look at because, as I mentioned before, I look at deal flow. I have a number of companies that come to me, and I do an initial screen of them for quality and for fit with our investor strategies before determining whether to pass along the opportunity. So what I look at is first and foremost at the team. I want to see a combination of both business expertise and biological and technical expertise. I want to see a proof of at least an ability to scale. And if it is a brand new company, then the hope is that someone on the team has experience scaling already. I want to look at and dig into the production metrics and the economics. As I mentioned before, I won't go into too much detail on that since that was the majority of my speech. But I also look at sustainability metrics, which often do tie into the financial one. So looking at what type of energy is being used, how much energy, how much water is being recirculated, and what's being done with the effluent, as well as the source of feed. And if there is a plan to transition to any more sustainable sources of feed. And then the last one I would say is that I would like to see demonstrated interest from the market, particularly if it's a niche species. And these conversations can often be quite long, so I won't take up the rest of our time outlining what I look at, but that's at a high level.
Yeah. The chat here gave us some examples of the ancillary companies that you were talking about. Is there a particular sector that you feel along the RAS value chain that you feel is very much under the radar for most investors?
So this maybe might not be what you think of when you first think of the value chain, and it's not an example necessarily of ancillary technologies, but in the ecosystem that I outlined and the inputs, it was there, which is labor. And there's certainly a shortage of expertise in this space, certainly because it's a new space, but it is challenging when I'm talking to companies and I want to see that they have that expertise on the team, but it is limited. And so often when I do talk to companies and they have that expertise, I also ask them how they plan on keeping those people on their team. And so one thing that I think will be really important in order to drive the overall success of this industry is building up a greater number of people with the expertise in land-based aquaculture and RAS. And then I think it's also important, so I'll note that we bring in more women to the space as well.
Do you distinguish different risk levels for investing in specific species, for example, that are raised in RAS facilities like salmon, tilapia, shrimp?
Yeah, that's a great question. So there are different risk levels that I look at, but I think there's also other benefits. Taking salmon, for example, Atlantic salmon is a commodity product. And so that can be a risk, but there's also a lot of demand for it globally. It's a well-known product, and there's a significant market for it. With lesser known species, those high value species have the potential to offset some of the high costs of RAS, but it is also necessary to make sure that particularly if it's a lesser known species, that the market is big enough that you actually see that value. So I would say it's not the species inherently that would make or break a decision, but rather how it plays into the broader business plan. So what markets are you trying to go after? How are you trying to go after them? Are you producing a value added product and so on? That really make a difference in the positive economics as well as the risks.
Okay. I think that's all the time we have for now. Thank you, Maggie, for your presentation and for your insights. Thank you to those who submitted their questions. If we didn't get your question or you weren't able to think of one at the time, Maggie is available for the rest of the day's event. So feel free to send her a private chat through our platform. We will now have a 30-minute break to give you a chance to stretch, get coffee, and more importantly, check out our exhibit hall. I'll see you at our first panel discussion, Investor Profile. Thank you.